Hi everyone, I'm Navila and welcome back to a lesson a day. In today's video, we are going to talk about current assets and liabilities and non-current assets and liabilities. So without any further delay, let's just get started. So in our previous video, we learned the meaning of the accounting terms which are assets, liabilities and capital. So make sure you go and you watch that video. And at the end, we learned that assets, which are the resources either owed by the business or owing to the business, is equal to the loans that it took from other people to keep the business going, plus the investments that the shareholders or the owner of the business made. So we can see that the accounting equation stands as assets is equal to liabilities plus capital. If we have the value of any two of these terms, we can easily find out the value of the unknown one. In our example, let's assume that we do not know the value of capital. We have the value of assets as 30,000 in whichever currency you want to take that in. And in liabilities, we have 12,000. So we know that assets is equal to liabilities plus capital. From there, we can find out that capital is equal to assets minus liabilities. So when we deduct 12,000 from 30,000, we get 18,000, which is the value of our capital. Let's see the second example. Let's assume that we do not know the value of liabilities. We know the assets as 85,000 and we know the capital as 65,000. We know that assets is equal to liabilities plus capital. From there, we can find out that liabilities is equal to assets minus capital. So when we deduct 65,000, which is the capital, from 85,000, which is our asset, we can find out the liabilities as 20,000. In the same way, we can even solve the examples 3 and 4. Present anything that is owed by or owing to the business. Example, cash, machinery, trade receivable, warehouse, etc. Now there are two types of assets, current assets and non-current assets. Current assets are assets that are expected to be converted to cash within a year. It represents all the assets of a company that are expected to be conveniently sold, consumed, used, or exhausted through standard business operations within 1 year. They are expected to be sold or used over the next operating year. Now, current assets are important to businesses because they can be used to fund day-to-day business operations and to pay for the ongoing operation expenses. Some examples are cash, cash equivalents, accounts receivable, stock, inventory, etc. Now, accounts receivable is the money due to a company for goods or services which are delivered or used but not yet paid by the customers. This is considered as current assets as long as they can be expected to be paid within a year. So we can understand that current assets are the assets that the company or the business can convert into cash within the year that they are operating. Now, non-current assets are a company's long-term investments that have a useful life or that have more usefulness of more than just 1 year. Non-current assets cannot be converted to cash easily. They are required for the long-term needs of a business and include things like land and heavy equipment. There are also some other examples, that is land, building furniture and equipment. Now from this we can understand that some of the differences of current and non-current assets are that The current assets are equal to cash or will be converted to cash within one operating year, and non-current assets will not be converted into cash within 1 year. Current assets are used to fund immediate or current needs. Examples: cash, cash equivalents, short-term investments, inventories, account receivables. And non-current assets are used to fund long-term or future needs. Some examples are long-term investments, long-term deferred taxes, assets, goodwill, etc. We know that liabilities represent anything that is owed by the business or whatever that the business took from other people that they did not pay for yet. So, current liabilities are a company's short-term financial obligations that are due within 1 year or within a normal operating cycle. Liabilities that must be paid within 12 months. For example, a business took a loan from a bank. Now, if this loan must be paid within 1 year, then it is a current liabilities. But in most cases, the loans that are taken from the bank are repaid within more than 1 year. So, in that case, it will be non-current liabilities, which are also known as long-term liabilities. They are obligations listed on the balance sheet which are not due for more than 1 year. Some examples of current liabilities would be accounts payable, accrued expenses, and short-term notes. These are every loan or every liabilities that a business must pay within 1 year or within a normal operating cycle. Non-current liabilities are all those liabilities owed by the business or resources owed by the business that the business does not need to pay within a year. And that is all for today. Thank you so much for watching. Bye everyone.